Good morning and welcome to this Wednesday, June 8th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, futures were down overnight. We've tried to rally a little bit ago, and now they seem to be moving in the wrong direction again. The last couple of days has been kind of strange. We had a gap up and then selling, then we had the gap down, then buying. But net, we've been holding up pretty well, just kind of going sideways here after a nice rally off the bottom. The question is, are we going to break out to the upside out of this trading range, or are we going to roll back over? One thing we got to be a little concerned with is that we are in this profit-taking period of the calendar month. 7th to the 10th. If you've heard me talk about historical trends and the tendencies in the market, we know end of the month into the first week of the month tends to be bullish, but then you get to a period where historically we see the market struggle a little bit, and that's the 7th through the 10th. 7th was yesterday. We actually had a pretty good day after gapping down. Today we're seeing futures down a little bit. Just keep in mind that the next 2 days, the 9th and the 10th, we've got some pretty good economic reports coming out. Tomorrow, initial jobless claims. Of course, we get that every Thursday. But then Friday's the biggie. Friday, we've got the May CPI report coming out. And I think that's the report that a lot of folks are really watching for. And I'm going to talk a little bit about inflation and some of the things to look for in just a few minutes. But before I get into any of that, let's go ahead and go over to EarningsBeats. For those of you who are new, welcome. I'm glad to have you. If you go over to EarningsBeats.com and you scroll down, we have a free newsletter. It's our EarningsBeats Digest, published 3 times a week, Mondays, Wednesdays, Fridays. All it takes is a name and email address. No credit card required. You can unsubscribe at any time. But put your name, email address in there, hit that subscribe button, join our community. I like to think of it as a very educational newsletter. I'm just trying to point out things that we like to focus on at EarningsBeats. So a lot of it will deal with earnings and relative strength. Maybe I might focus on some candlesticks from time to time, moving averages, trend lines, all those types of things. Every once in a while, it'll be something about the big picture, the overall market on the S&P 500. Or maybe a focus on an industry group. But anyway, I think it's very educational. Sometimes there'll be some trading opportunities for some of you if you so choose. Of course, that's completely up to you. I'm just pointing out, what I'm seeing, trying to use it for educational purposes. But if you see an opportunity to trade, by all means, trade. Anyhow, this is a great way to get to know us if you are new to EarningsBeats. And if you've been around for a while listening to the shows and you haven't signed up for the EB Digest, I think you're probably missing out. Anyway, go on over to EarningsBeats. Make sure you scroll down, find that, and sign up. Also, our portfolios are starting to perform really well again. This cyclical bear market's taking its toll on a lot of folks. We've been kind of shifting our focus throughout this bear market. I think we've held up pretty well versus the S&P 500. But this latest quarter, if you look at this quarter now, when I talk about this quarter, I'm not talking about calendar quarter. I'm talking about when we drafted. So every 90 days, we put 10 equal weighted stocks in each of these 4 portfolios. And the last time we did that was on May 19th. So that was roughly, 3 weeks ago, 2.5, 3 weeks ago. And over that time, we've had a big rally in the S&P 500. You can see we're up 6.66%. But our portfolios have actually done much better than that. Model portfolios up almost 11%, aggressives up 10.3%, even strong AD, which has been struggling the last few quarters, up almost 10% this quarter. So we are seeing some nice relative strength in some of our portfolios. So if you want to check that out, you'll actually need to be a member, but we do have a 30-day free trial. So we'd love to have you there. All right, let's go and talk a little bit about the action from yesterday, Tuesday, June 7th. The Dow Jones Industrial Average finished up 264. S&P 500 was up 39. NASDAQ up 113. Mid caps up 32. And then small caps were up 14 points. So all of this pretty good action, especially when you consider that it wasn't so great in the morning. So we saw improvement throughout the day, which was good. When you get gap downs and then followed by buying, that's a lot better than gap ups followed by selling, because you can't get accumulation at the opening bell. The market makers are looking to see the imbalance between demand and supply. And so prices can open well above the prior day's close or beneath the prior day's close, just depending on the demand that they're seeing, the news that's out there, and so forth. But if a mutual fund wants to buy 1 million shares of a stock, you just can't get in on that opening bell. You can't just say, hey, I want 1 million shares. I mean, you could, but obviously that's going to create tremendous imbalance between demand and supply. So that particular stock's going to open up, through the roof with that kind of an order. So the way mutual funds acquire stocks, or any professionals acquire stocks, is they go through market makers. Market makers are traders. They help accumulate shares for their institutional clients. That occurs during the trading day. So when stocks are opening up and closing down, that's selling throughout the day. It's hard for major accumulation to take place when there appears to be more sellers than buyers. So it's going to be very difficult to make any kind of headway into the type of position that you want as a professional without the market reflecting it in an upside move. So, and that's why I'm looking for rotation into some of these aggressive areas right now. Money coming out of some of the more defensive groups and into more aggressive groups. We're not really seeing that. Haven't been seeing that as much. But those are some of the things we're looking for. As far as the sectors go yesterday, energy, big surprise, up 3%, leading the action. Industrials, 1.3%. Healthcare, 1.3%. Technology, 1.2%. And then really the only loser on the day was discretionary, down about 0.25%. But if you look closely, it's hard to do that on this candle glance where we got 10 small charts. But if you look closely, many of these opened at or just below 20-day EMAs yesterday, and things could have turned the other way. And instead, we saw buyers come in. So at least for now, we're holding on to what I think is critical short-term support, those 20-day EMAs. Can't have an uptrend without trending above at least that short-term moving average. So, and you can see on the charts right now, we're doing that. We're holding on. Mid cap, small cap seem to be continuing to move higher, whereas the NASDAQ, S&P, and Dow simply are going sideways here over the past week or two. 10-year treasury yield, not much out in the way of economic news. We do have some biggies coming up. As I mentioned, initial jobless claims tomorrow morning. We got the May CPI coming out on Friday, core CPI as well. The headline CPI number is probably going to look bearish. April's headline number was only up 0.3%, and May's expected to jump 0.7%. So that in itself probably is going to look bad. But you have to remember the Fed is stripping out volatile energy and food prices. And you might say, well, Mike, why would you do that? I mean, energy is going crazy. Food prices, go to the grocery store. How can you ignore it? Well, it's not that they ignore it. It's just they recognize the volatility there. If they raised and lowered rates every time crude oil made a move or food prices made a move, but especially crude oil, they'd look nuts. I mean, they'd be raising half one month, next month lowering half. That's not what they're trying to do. They're not worried about those volatile areas. They're worried about, when you strip out and you get down to the core level, areas that aren't as volatile. When those prices start consistently moving higher at an accelerated rate, that's when the Fed gets nervous. So that's your core CPI. And the core CPI in April was up 0.6%. In May, it's actually supposed to drop to 0.5% increase. So at the core level, we're looking for it to come down a little bit. I'm going to show you couple interesting charts here in just a minute on inflation. But in the meantime, here's your treasury yield, 10-year treasury yield, which right now we're at about 3.02%. We have gone back through that 3% level. I'm expecting that we're going to make another run up here to about 315, 316, 317. If we get through, watch 3.25, because it's been 11 years since we've gone above 3.25. So those are areas to watch to the upside. I don't know that the market's going to be spooked by just a move back up to where we were, because we've already handled that. I think where the market could be spooked is if we go through this 317 area and start challenging that 3.25 area, and especially if we move through 3.25. I mean, then you're talking about an 11-year high on the 10-year treasury yield. Think about where we were just a year or two ago. Look back to August of last year. We were at 1.10, 1.1%. Now here we are 3 times that almost in less than a year. So sometimes it's not just where the interest rate levels are, because interest rates at 3% on the 10-year treasury yield, historically, I'd expect the stock market to explode to the upside. That's very, very low rate historically, but it's the rate of the hikes. It's the rate of ascent of the 10-year treasury yield that's presenting problems, and I think potentially throwing us into a recession. So anyway, let's watch that 10-year treasury yield. I think the stock market could get spooked if we do go back up and break to new recent highs. All right, S&P 500. Now on this chart, what I have, this is going back a couple of years. I think you can clearly see the uptrend that was in play. Now we have a downtrend in play. That's part of the secular bull market. This to me is a cyclical bear market. We'll see. That's what I'm calling it. Feel free to call it what you want. A lot of folks think this is a secular bear market. It's going to go on for a long time. I am not in that camp. I don't know if we've bottomed yet. This was the second of 3 lows that I suggested back on, early January. I thought minimally we'd get down to 4,300, which we hit almost 2 weeks or 3 weeks after we talked about it. We bounced, went back down below that. That was the first level, 4,300. Second level was that cyclical bear market level, 3,800. We got right down there, got that 20% move down in the S&P, hit 3,800. And my third and final target, and I think it's still possible, was 3,500. And I think if the inflation report this Friday comes out hot and the Fed keeps talking tough about raising, and we got the summertime, which normally isn't great for stocks anyway, I think it's very possible we could still get down to 3,500. But if we do, I would be buying with both fists. That's just me. I think this is going to set up a great opportunity into the fall, into year end, into 2023, when I believe inflation will not be talked about anymore. It's going to be more about recession. And I think once that flips and the Fed is more worried about recession than it is inflation, that's when their policy changes. And when their policy changes, growth stocks explode. When they, even talk about the possibility of being dovish, I think growth stocks not only will explode, but I think they're going to be moving higher even before the Fed starts to make those kinds of comments. So that's what I'm looking for. Now on this chart, what I have for you are large cap growth versus large cap value, mid cap growth versus mid cap value, and small cap growth versus small cap value. And what you'll see first off is that while the S&P 500 was going higher in the first half of last year, growth stocks were getting hit in the first half of last year pretty hard relative to value stocks. So the market was still going up, meaning that some of these growth stocks were still going up. It was just that the value stocks were going up faster. So there was rotation. You might say, well, why would that be in a secular bull market? Well, here's the CPI, the core CPI chart. And I want you to look here at 2021 because, let me pull this back down here. Starting in March of 2021, that's the March core CPI jump. That gets reported in April. The April jump got reported in May. The May jump got reported in June, and this June jump got reported in July. This is when not only were we seeing core CPI jumping, but it was replacing the months from 2020 where it was dropping. So it was like a double whammy. We were losing, we were dropping off these deflationary readings and replacing them with increasing inflationary readings. So when March, April, and May got replaced, these were all going down. These were all jumping. So what happened was, this is a 12-month moving average. This is why we had such a huge spike in the annual rate of core inflation last year. It was because all of these months, these big spikes replaced these lower readings. All this is a look back of the last 12 months. That's all this annual rate of inflation is. So you get rid of one, so we're getting ready to have the May number come out this Friday. So we'll get rid of this jump right here. And what I pointed out is I thought that we could be seeing a top in inflation in March. And the reason I said that was because March reading, April reading, May and June, this is when inflation picked up significantly. So last year we had the big spike because these increasing numbers replaced these decreasing numbers. Now, I'm not expecting inflation is going to drop in these months ahead, but I just didn't think on a percentage basis they would go up as much as we saw last year, which means the overall annual rate comes down. That's why I was calling for a top. Now, at the bottom of this chart, I have a 1-month rate of change. And so last month, the CPI, monthly core CPI, came in at 0.6%. And it's rounded, by the way, to the nearest tenth. The actual number was 0.57, and that's showing up here on this chart. But here were those monthly increases. So when I go back and I look at April, May, and June, I want you to just take a look at this. Here's April, May, and June going up, and look at the spike on the 1-month rate of change. 0.9, 0.75, 0.8. Those three, April, May, and June, replaced April, May, and June over here. Well, you can see April was really low. And even the March reading right here at 0.3 replaced a slightly negative March reading the year prior. April was minus 0.4, and we replaced that with 0.9. That's 1.3 percentage points right there. And that's why this goes from 1.7 to 3. There's your 1.3%. So all this is a math thing. Don't sit back and wait for the media to start telling you how bad inflation is. We can see it on a monthly basis. Now, my point here, though, is that these 3 months, April, May, and June, are about to be replaced. April has already been replaced. May is going to be replaced this week. We're expecting 0.5%. Well, we had 0.75% last month, or last May. So if we come in with the consensus estimate, we're going to see this drop below 6%. The annual rate of core rate of inflation is going to drop again. And you know what? Next month, we're going to be replacing 0.8 with whatever comes out. So unless it's 0.8 or higher, we're going to see another drop. And that's why I said the 6.50, we could see this drop to 5.50 in the next couple of months. Now, historically, when we top in inflation, we normally top, or are pretty close to topping, in value versus growth, or bottoming if you're looking at growth versus value. So this top would coincide with bottoms over here on these growth versus value ratios. Well, I mean, in May, we're trying to come up, still a little early, I would say, to call this a bottom. I think we got to do a little bit more to the upside. Right now, it just looks like for the last 6 months, we've been trending lower. So still got a lot of work to do here, but this is one of the ways I'm looking at the market, looking at inflation, and then trying to see what Wall Street is doing. It's more than just reading what the media is telling us. If you're doing that, of course, you're going to think it's Armageddon. That's what they do. That's how they get folks to click on their articles. Everywhere you turn, it's bad news. So, we all get programmed. And, I'm not just saying that now. I was saying that when we were at an all-time high back in January. I said we needed to reset sentiment. How do you reset sentiment? Well, everybody's got to get more bearish. Well, how does everybody get more bearish? Well, first of all, the market has to start dropping. And second, the media has to treat it as though this is the worst thing that we've ever seen and experienced in our entire life or ever will experience. This is the worst. Everything's horrible. My gosh, look at all the news. We got a war, we got spiking oil, we got the Fed raising rates, we got higher interest rates, we got higher inflation. My gosh, this is awful. Well, we'll find out how awful it is. I mean, I believe we're going to start seeing the news improve later in the year and into next year. And before that even happens, the stock market will start going back up. All right, couple industry groups. I wrote about these, sent them out to our members at EarningsBeats. I think it was yesterday. Might have been the day before. I think it was yesterday, though. Home improvement retailers. I'm always talking, or mostly talking from the long side, because I tend, especially if it's just a cyclical bear market, I'm not going to short, or it's going to be very, very infrequently that I'm going to short. I normally will sit in cash because the whole time the market's coming down, my buying power is going up. If I'm not doing anything that I got out of back in December and January is obviously going to be a lot cheaper now. That means I can buy more of it with the same money. I have higher purchasing power. So I'm fine. That's, and the reason I say this quite often, but the worst thing for me as a trader is shorting the market and all of a sudden the market goes up. If I'm long stocks and the market goes down, I don't like it. I lose money. But I guess I'm trained to accept losses on the long side from time to time. On the short side, I mean, if I'm mostly bullish, that is like nails on a chalkboard, pulling teeth. I mean, I don't deal with it well. So I don't like to short. I mean, I like to short if I'm making money, but if the market goes against me, that's the worst for me emotionally. And I start making emotional trades, which once you start doing that, I mean, you might as well just hand your money to the market makers. You've got to be much more disciplined. So I've been stressing patience, recognizing that we're going to have a lot of volatility this year and trying to wait patiently for a market bottom. Now, for those who got out at the top, could you be buying now? Yes. I think, if you're getting into the spider or the QQQ or something, I'd be using weakness to get in. Absolutely. I might be able to call the bottom. I might not. No one's going to scream it's a bottom. No one screamed it was a top, but there were enough signals to point to see the top. Will we get those signals at the bottom? I don't know. Looking for them right now, but I'm not seeing a whole lot of them. Now, when I look at, the whole reason for pulling this industry group up is folks will say, well, what do you think about shorting? Well, I'm not a fan of shorting, but if you're going to short, I don't want to chase. I don't want to short after we have this huge drop. I want to short after we've had a rebound. So if you look at something like the home improvement retailers, once we dropped below the 50, I mean, that occurred back at the beginning of January. We've had one, well, maybe two closes, it looks like, over the 50-day, barely. And we've had enough strength here to at least get the 20-day moving higher. So if I was thinking about shorting, and I'm not shorting right now, I'm not doing any, I have no shorts. But if I was, I'd be looking at some of these areas that have been very weak, that have bounced and have gotten close to resistance. Because that way, if it breaks out, I can get out pretty quickly without losing a lot. But if it just simply follows its recent 5-6 month pattern and rolls back over again, I can do really well on the short side. So I'd be looking at something like the home improvements, area. You can see here, we were bouncing. And even though the market, we're trying to come back on a relative basis, this group still is not really leading. And it looks like it's trying to roll back over again. So this is a group that would have my attention. Another group that would also have my attention would be home builders. Now, home builders have started to break back above key moving averages. But if you look back, this 1250 to 1270 area was key support for about a month. And look at this volume that came in late March, early April, when we broke that area of support. We got up there, set, got the resistance, turned around, went right back lower again. And now here we are trying to get back up to this key resistance level. Now, home construction may have bottomed. Maybe we're going to bounce off the 20 and we're going to just shoot right through this resistance area. And if we do, then I would cover any shorts that I had. But I don't think we can just assume we're going to go charging back through at this point, given everything that we've got going. I don't know what's going to happen with the big CPI report on Friday. We know the Fed is being hawkish right now. That's not good for the market. It's not good for home construction. So we'll see what happens. But if we can't break through 1270, my guess is we're going to head back down the path of least resistance is to the downside, in my view. So that's what I would be looking for. It doesn't have to be these two groups. I mean, there's a lot of industry groups, mostly in the aggressive areas. We've had semiconductors, software. Some of them are starting to look better, but they're still in longer term or intermediate term downtrends. If we look at something like semiconductors, you can see this support area, 7,200 to 7,400. It basically held every one of these moves to the downside for 6-7 months. Then we fell apart. Volume was pretty heavy. And now as we've come back up, look at where we're struggling. We struggled here at 74, struggled here at about 7,350. Right now we're near 7,200. This is the area to the upside we have to watch, because this is the area that held to the downside. The PPO's right back to the center line. So again, if you wanted to short, this wouldn't be a bad area on semiconductors. But if I'm right about the market bottoming and this turns out to be the bottom, you don't want to just stick with your shorts if these stocks start moving back up. So make sure you keep a line in the sand on your semiconductors if this is an area that you're thinking about shorting. All right, earnings spotlight. I mean, no really big companies. Campbell Soup reported this morning. They beat estimates, 70 cents versus 61 cents. And if we pull up this morning, they're up 2.5%. So getting a little bit of a move up to the upside, going to try and get through that 20-day. We'll see if it is successful. Thor Industries had a pretty good report. 632 versus 497 earnings per share. That's netting the stock a whole 2% to the upside. 77.68. This is about where we've been topping recently. We'll see whether or not we can break through there. After the bell yesterday, we had Casey's Casey's General Stores, CASY. This one's actually been in an uptrend. It was sideways consolidating, but it is down 2% or $4 back to about 202 today. They beat $1.60 versus $1.54. I actually like this chart. This is one of the few I think look pretty solid, moving up, sideways consolidating. Anything back down a little below 200 would get my attention. I would think as long as it stays above 195, should be okay there. So, and that's kind of what I'm doing right now. I'm actually looking for stocks that are doing a little bit better and trying to find support areas to trade. And I'm not in it, like I would be in a secular bull market. Secular bull market, I might buy a stock and hold it for a few weeks, maybe a month or more, as long as it continues to trend in the direction that I'm looking for. In this market, there is no way I'm thinking about holding anything for a month right now, not individual stocks. A lot of times I'll buy a stock, and if I get 1, 2, maybe 3%, I'm out. And I try to end the day with as little invested as possible, because I just don't know which way we're going to gap. I go through and I read some of the comments sometimes on my videos. I don't really have a whole lot of time, definitely not much time to respond, but I do read your comments when you post anything. And I was looking at one the other day, and somebody had written and said that I'm all over the place, that I'm bullish one day and bearish the next day. And look at the market. Isn't the market doing that? I mean, the market's going up, it's coming down. I don't know from day to day what the market's going to do. I know long term, I believe we're going higher. I think intermediate term, we're in a cyclical bear market. But if you're asking me to try and pinpoint the market each day, I mean, that would drive me straight to the insane asylum. I have no idea when I go to bed at night what the market's going to look like when I wake up in the morning. I just know that the overall trend right now remains the downside. So, if you can figure out where the market's going to be in a day or two from now, let me know, because I really don't have any idea. So I'm just looking at our chart list, and I look at something like our strong AD chart list, which I wrote about in the EB Digest this morning. But our strong AD chart list features companies that tend to do better later in the day than they do in the morning. That's what the strong AD line is all about. And so there are stocks that have recently just, been struggling in the morning, and then they come back in the afternoon. So some of those stocks, I can trade, make my 1 or 2%, and get right back out. And I'm trading mostly small positions as well, not taking any big chances in this market. A lot of stocks I trade are defensive in nature. Haven't done a whole lot of trading with aggressive stocks. Occasionally, I'll look at a stock like Zoom or Tesla, and maybe try to trade it. But I make sure I keep my stops in play. Anyway, just a couple of earnings reports there. Really not a whole lot going on. Let's wrap this thing up where it's past 9:30. Market just opened. So I'll start off with M&T Bank. This is another stock that I showed our members recently, I think last couple of days. But notice how banks have been going down all year. Look at what MTB's been doing. Sideways, actually not far from a breakout. So what does that tell you on a relative basis? It tells you got one of the strongest stocks in the bank area. Now, does that mean I would just rush in and buy it? No, but I want to be aware of MTB as being one of the leaders when banks do start to move higher. If M&T Bank breaks out and the banks are just starting to move to the upside, that could be a great trade. Or if the banks weaken and MTB gets all the way back down here, 155, 160 down near support, that could be a great entry point. Going into the leaders as it tests a major support level. Now, a couple other banks I'll show you. Here's JP Morgan, just to show you, the maybe little differences. Here you got JP Morgan trending lower. It's actually shown some recent relative strength. We'll see if that continues, but I'm, a little nervous. I'd be careful if JP Morgan loses its 2 moving averages right here. And then the last one I'll show you is Wells Fargo. This is the one that I was pretty big on heading into the end of the year, beginning of the year, mostly because the relative strength. Now it's holding on to its relative strength, but it's not setting new highs. So it's basically just been going along for the ride the last 4 months with the whole banking group. The unfortunate part of that is the banking group's been going down. So that means Wells Fargo has been going down. So those are just 3 different banks. But for me, I would say if I had to rank them, I'd have M&T first. I like Wells Fargo second, and I like JP Morgan third. I think the fact that we had this relative strength and we've been holding it, I would be looking eventually for another relative move to the upside in Wells Fargo. Anyway, that's all I have for today. Let's take a look and see what the market's doing. We're 4 minutes in. Dow down 226, S&P down 25, NASDAQ down 47. Small caps, mid caps down. So we're seeing a little bit of downside action. Is this the start of a move down with the CPI coming out on Friday and being in that 7th to the 10th period of the month? I don't know. I can only tell you tendencies, and the market does have a tendency to move lower this time of the month. I think we're in that sideways consolidation period, here over the last week to 10 days where we've just not really been sure which way we want to go. What I would be careful of is a big red candlestick on the major indices where we break below recent lows. Could come today, could come tomorrow. Maybe it's on Friday. Maybe it doesn't come. Maybe the bottom is in the market. But to call that, I need to see more rotation into aggressive areas. Not enough of that just yet. Anyway, that's it for me. Tomorrow, I'll be back over at Stock Charts TV. So if you come in here at 9 a.m. Eastern tomorrow, you can listen to me on Stock Charts TV. Just click on that link right there, and you'll be part of it. Anyhow, everybody have a great day. Happy trading.